we're moving into a deflationary environment is increasing by the month, especially because the Fed is railing against inflation when it is already coming down quite significantly. You know, it's interesting to listen to reports like Costco's and Home Depot's. Costco's basically saying, okay, we're going to have to clear inventory by cutting prices. They just come right out and say it, but the Fed's not incorporating those sorts of variables into its analysis.
In June, the U.S. added 209,000 new jobs, signaling a potential cooling of the economy. This number fell below economists' expectations of 240,000 jobs and was lower than the 309,000 jobs added in May. Nevertheless, this increase marked the 30th consecutive month of job gains, and the unemployment rate declined to a historically low rate of 3.6%. Despite the Federal Reserve's aggressive efforts to slow the economy and control inflation through a series of interest rate hikes, the U.S. job market has remained robust. Federal Reserve Chair Jerome Powell has hinted at the likelihood of further rate increases this month after announcing a pause in June. Wages rose by 4.4% in June from the previous year, with an annual rate of 4%. However, U.S. inflation still remains twice as high as the Fed's target, raising concerns among some economists that the central bank's steep rate hikes could lead to job losses and trigger a recession. ARK Invest CEO Cathie Wood shares her insights on fiscal policy, monetary policy, and her projections for new data that will be available in the coming weeks, offering valuable perspectives on the economic landscape.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Fiscal policy to start. We are heading into the election year campaign season. And so what that means is we're probably going to experience gridlock, which is a good thing. It means there will be little to roil the markets, we think, during the next year from a fiscal policy point of view. So that's good. Monetary policy, we still have the Fed, interestingly, not mentioning money supply at all. Money supply is down roughly 5% on a year-over-year basis. Haven't heard a word out of the Fed on it. Maybe you have, but I haven't. It is still very focused on inflation and employment. Now, employment, we had so many indicators in the last week or so that there was something for everyone, bulls and bears. So today we got the non-farm payroll. It was below expectations at 209,000. Expectations were 230. But the important point was downward revisions, 110,000 jobs revised away over the last few months. So that made this quite a weak report from an employment point of view. But if you looked at average hourly earnings, they were a little better than expected. The Fed may not have liked that. And average work week was a little better than expected. So those probably all netted out to something a little weaker, not a lot weaker than expected. Now, we got all kinds of indicators. We got the ADP on Wednesday, employment, which was almost 500,000. And, of course, that roiled the market. In today's report, household employment, as you know, we focus on that because it captures more of the small businesses that are very important at turning points in terms of a leading indicator. Last month, those jobs were down, negative 310,000. But this month they bounced back, not all the way, but 273. In the report today, temporary employment was very weak, very, very weak. I rarely see it that weak, so I took note of that. And we also got the job openings report this week, and the number of job openings dropped by about 500,000. So again, as I said, something for everyone, including the Fed. The Fed seems to want to pay attention to the stronger numbers. So that is the employment side. On the inflation side, we see a year ago the commodity prices started falling pretty precipitously, and so now we're coming up against the comparison against that drop. So commodity prices, which had been down on a year-over-year basis by 20 to 30%, are now down roughly 12%. So again, we're comparing against declines last year. Now, if you look at the Bloomberg Commodity Price Index, it is still in a downtrend. So that is a leading indicator for inflation. The PPI reported this past month was up 1.1% on a year-over-year basis. So the Fed has a 2% target on a year-over-year basis. We've got two leading indicators that are well below that, commodity prices and the PPI, up only 1.1. If you look at the retail sales deflator, this is a number you kind of have to back into, and not many people pay attention to it. But it does belong to the retail sales report, which is a little more goods-oriented than services-oriented. But that is up only 0.2% on a year-over-year basis.
According to the latest data from the Bureau of Labor Statistics, the private sector reported a sharper-than-expected rise in hiring in June. Private employers added an impressive 497,000 new jobs, a significant increase compared to the 267,000 gain in May and far surpassing the estimated 220,000 jobs. This nearly 500,000 rise represents the largest monthly increase in over a year, with leisure and hospitality jobs contributing to the most substantial volume of hires. Despite the robust private sector hiring, there are indications that the job market may be cooling. The number of job vacancies in the U.S. is declining, with 9.9 million open positions on the last day of May. There were 1.6 unfilled positions for each person considered unemployed. While this figure is down from the record 12 million open positions in March of the previous year, it remains higher than pre-pandemic levels. Additionally, Cathie Wood shares her perspective on the rising number of bankruptcies and its potential implications for the economy, offering valuable insights into the current economic landscape.
Just the backdrop, though, away from these numbers, we're seeing rising bankruptcies, and a lot of the reason for this is because a lot of businesses take loans out on a floating rate basis. In fact, those are the only kinds of loans they can get, and the rates have gone up so much, 21-fold if you look at the Fed funds rate in a little more than a year. And a lot of businesses just cannot afford these loans anymore, and you're seeing the same with commercial real estate. Strategic defaults, left, right, and center, just can't put up with the interest rate increases and the empty office buildings. One of my dear friends, a doctor in one of the best parts of New York City, Madison Avenue, Midtown. She's being evicted, and so is everyone else in the building because it's only half full. And this used to be prime property. Maybe that's too New York specific, but I wouldn't be surprised to see the same thing happening in many other big cities around the world, maybe even the smaller ones, given the regional bank issues out there. Where else would we expect to see issues having to do with this massive increase in interest rates in such a short period of time? Well, we're learning now that in the private equity world, where you see a lot of collateralized loans, that there were $3 trillion. This is as of last August, but by that time, the Fed had already been jacking interest rates up by 75 basis points at a clip. $3 trillion in adjustable rate, unhedged loans of that sort. So I think underneath the surface out there, we're not hearing a lot about this, but that there is a lot of pain. And we also see that the KRE, which is the regional bank index, is just wallowing around where it was roughly during the regional bank crisis earlier this year. So no real recovery there either. And of course, one of the reasons is the biggest lenders to commercial real estate these days are not the big banks. They're not allowed to allocate that much risk to commercial real estate, but the regional banks. So we believe they are in quite a bit of under some stress. And that will continue if rates continue to move up, because the incentive to move to money market funds or government-backed funds is only going to increase. I think when the Fed will shift its spots is when companies start responding to margin pressures, as consumers start saying, we are not paying higher prices. And we're seeing that more and more. Costco's report was a very good case in point. And at that point, margins will start to come down. And they've already started coming down. If you look at corporate profits, the corporate profits measure in the GDP accounts, which is it's called after-tax corporate profits adjusted for IVA and CCA. Those profits have already started rolling over. So companies are already beginning to feel a little bit of heat. We think that will intensify going forward, and that as a result, companies that have been hoarding labor, it had been very hard to get over a long period of time, hoarding labor, are probably going to let some of those employees go.
The Federal Reserve's plan to continue hiking interest rates to combat inflation is likely to result in an increase in corporate default rates in the coming months. The corporate default rate already rose in May, indicating that U.S. companies are facing challenges due to higher interest rates, making it more expensive to refinance debt, and uncertainty in the economic outlook. So far this year, there have been 41 defaults in the U.S. and 1 in Canada, surpassing the same period in 2022 and being the highest in any region globally, according to Moody's Investor Service. Fed Chairman Jerome Powell has announced more interest rate increases this year, albeit at a slower rate, until progress is made in lowering inflation. Market observers and analysts attribute the distress of companies to the high interest rates, affecting firms in need of liquidity, or those burdened with substantial debt loads seeking refinancing. Distressed exchanges, debt repurchasing, or restructuring may be the options for these companies, but the capital is now much more expensive than in previous years. As a result of these developments, bankruptcy filings have increased. There were 324 bankruptcy filings in June 2022, not far behind the total of 374 in 2022, and the global default rate is expected to rise to 4.6% by the end of the year, surpassing the long-term average of 4.1%, according to Moody's projections. However, the rate is predicted to rise to 5% by April 2024 before gradually easing. These projections raise concerns about the impact of high interest rates on the stability of various industries. You are encouraged to share their views on these projections in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.